All right, we're here with InsiderSentiment.com, and we're here with another conversation with Professor Nejat Seyhun. And what are we going to talk about today, Professor?
We're going to talk about these really exciting developments over the weekend and today. Peace agreement has been signed after 4 months of on and off fighting. Hormuz is open, apparently. Oil is flowing. Oil prices have come down 5%. Stock market's gone crazy. So it looks like there are a lot of positive developments. So somebody could think that all the problems are over. The answer is some are, but not all. And that's what I want to talk about today.
All right, why don't we start with sort of the overall macro picture, and also let's get into why you're framing this as a reprieve exactly.
Well, the reason I'm calling it a reprieve is because Warsh was between a rock and a hard place, if you like. Before this weekend, inflation is running very hot, and we had some weaknesses on the economy. Leading economic indicators down, the unemployment numbers were steady, the employment numbers were fluctuating, etc. There are a lot of consumers are sending red flags all over the place. Consumer sentiment is at all-time low. So against that background, his job was almost difficult or impossible. He couldn't raise the rates, that would make the real economy worse. He couldn't lower the rates, that would make inflation worse. So all he had to do was hold, and he'd be criticized by everyone, including the president. So now what we have is a reprieve from that scenario in that uh, oil prices are falling, will probably continue to fall. I don't think they'll go back all the way to 55, but that's going to give them a reprieve. And stock market's going up. That's going to invigorate the economy a little bit, the decline in oil and gas prices. And so he has an easier job now than he did a week ago.
Okay, so looking at some of these numbers on the slides here, you have headline CPI at a 3-year high, but core is only 2.9%. So, in your opinion, which number should Warsh be using to anchor his first decision?
Well, we have to pay attention to both, obviously, uh, because we don't know the future trajectory of inflation. So we've had a lot of producer price inflation. That's up to 6.5%. The CPI is more muted. The headline CPI is at 4.2, and the core CPI, the most important of all, is 2.9. So one possibility is that the PPI passes through to the CPI and it rises to 3.5, 4.5, 5.5%, which makes Warsh's job very, very difficult. The other possibility is the decline in oil prices dominates and overwhelms the inflation picture, and CPI stays muted, calm, and we have a soft landing. So that is the scenario we're in. We don't know which one of these is going to uh, take place. Political constraints are still has not changed, namely that the Trump administration would like cuts in the Fed funds rate, which is very difficult against this inflationary picture. And Warsh has sort of made a name for himself as being an inflation hawk, so he needs to maintain that credibility a little bit. But juggling all of these is very, very difficult.
And okay, how does this sort of factor into the scenario where markets price no cuts, but even start pricing in hikes, modest hikes? How would you say that fits in?
Well, there's long lags as to how prices react to a supply shock, such as the one we've had over the past 4 months. So one possibility is that the CPI is going to continue to increase, in which case it's going to make very, very difficult to cut rates, regardless of what the administration wants. The alternative is um, so one possibility is Warsh could declare all of this as transitory, as Powell did at one time, and basically say, look, the headline oil prices are declining, even though core is increasing, it's going to come back down. Don't worry, we're not going to raise prices as a result. That scenario is believable up to a point, as long as the headline oil prices continue to fall, PPI falls, headline CPI falls, even if core CPI increases, that scenario is still realistic. So I think he'll be able to hold on to that scenario for the next 3, 4 months. And as a result, we could have basically a hold right now, no change for a while, even if the CPI continues to increase. But there's a limit to how much that scenario will hold.
All right. I guess sort of a big question then, will the hot core PPI pass through to consumer core, or do you think it will fade as oil comes back down?
So again, we don't know the answer. Nobody knows the answer. We're going to find out, and that's going to tell us sort of which trajectory we're on. One possibility is that the decline in oil prices, we don't know how fast they're going to decline. If they decline really fast and come back to where they were around 55 before the war started, then there's a very good chance that the PPI is not going to pass through. The core CPI is going to stay tame, and Warsh can maintain his scenario that all of this is temporary, transitory, and no rate hike is needed. But if the other scenario holds, CPI continues to rise, then he can only hold it so much, at which point he may be forced to raise interest rates. We're going to find out, I think, sometime by early fall, so September. We should get some idea which one of those scenarios is more realistic.
All right. And what if there's a reclosure? How would that scenario factor in here?
That's another risk factor that is not currently being priced. So the markets are acting like Hormuz is permanently open. Hormuz is open today, but we have no idea how long it's going to stay open. So if Hormuz closes a month later, 2 months later, once again, because they haven't agreed on the nuclear deal and long range ballistic missile deal, support of various groups, militant groups. In that case, we're going to be in a probably worse place than we are now, because if Warsh maintains that all of this is temporary against a rising CPI, once Hormuz closes again, that scenario is out the door. So Warsh is not going to be able to claim that all of this is temporary. As a result, he's going to be forced into a rate hike, which is currently completely unexpected, which will make his life and the economy a lot worse shape than we are today. So yes, I agree. That's a big risk factor.
Markets seem to be pricing in a soft landing regarding inflation. Which single data point would you say most clearly resolves whether it is a soft landing or not?
I think we have to look and see how this gap between headline PPI and core CPI is resolved. If headline PPI is falling sharply toward core CPI, then I think soft landing scenario is being realized. That depends on how fast and how big oil prices fall. So if oil prices are falling sharply, likely we are going toward a soft landing scenario. If oil prices get stuck around 70 and stay there for a while, then chances are CPI is going to rise toward the PPI, which means inflation pressures are getting louder, which means the calls for rate increases will also be louder. So we should pay attention to how that gap is being closed, whether a CPI increase or PPI decrease.
Does falling headline inflation, do you think that would give Warsh real independence, or would it merely just postpone, say, like a clash with Trump?
Again, current situation has bought them probably 2, 3 months of reprieve from Trump administration, even if inflation continues to rise. He can always call it transitory and hold off on raising Fed funds rate, and he can still hold on to his hawkish credentials. But all of that depends on what's happening with these inflationary pressures, whether CPI is rising sharply, CPI is holding, PPI is falling sharply, or PPI is falling slowly. So we have to wait and see. Obviously, as you pointed out, reclosure of Hormuz is basically a wrench in the whole machine that will upset everything.
So, with the current forward PE of 22.4, how much of the melt up would you say depends on core staying low?
I didn't understand the question. Could you repeat the question?
At a 22.4x forward PE, how
Yes,
much? Yeah.
you're asking about the stock market. So, stock market's currently very much priced as a soft landing scenario. So, if interest rates go up, that's going to eat into the multiples. If the economy slows down because of persistent supply shocks, reclosure of Hormuz, that's going to reduce earnings. So, I'm guessing we could easily end up with something close to a 20% fall in the stock market from the current levels.
And what exactly should market participants be paying attention to? What sort of signals do you think are going to trigger these various switches?
So again, how the gap between PPI and CPI closes is a big signal. Future closures is a big signal. The economy itself is going to be a big signal. So we should pay attention to all of them. I would say if there's a reclosure of Hormuz, the current soft landing scenario is completely um, out of picture. So um, I would say beware to the stock market investors. So the soft landing scenario requires the following. Uh, Hormuz remains open, oil prices fall sharply, CPI does not creep up. If we see all of those, then I think soft landing scenario is still holding, which means stock market will hold its high levels, will continue to increase. Interest rates will stay low. There won't be any Fed funds raises. Oil prices will fall rapidly toward pre-war price of $55. Take away any of these, we're basically soft landing scenarios out the window, and our stock market is looking at a big risk.
So, just to sort of summarize, which would you say is the bigger threat, the PPI pass through or a potential reclosure of the Hormuz?
I would say they're both big risk factors. Um, so I don't have a view as to one of them is bigger than the other one, but they're both risk factors. If only one of them is realized, um, that means probably we'll get the negative scenario sometime in early 2027. If both of them are realized, Hormuz closes, CPI starts running up. That means we're looking at a negative scenario around election time, which is going to bring everything to a head very, very quickly.
All right. Well, thanks very much, Professor. Any final words?
I think the market is being pretty complacent. It's understandable, obviously, given the current developments, but I say the average investor should be very vigilant. The risks they look like they've disappeared as of today, but pretty soon they're going to come back. So we need to pay attention to them.
All right. Well, thanks again. Talk
My
to you
pleasure.
later.
My pleasure.
Bye bye.